everyone. I'm David Darst here to give you a recap of the first quarter of 2025, and it's certainly been packed with a lot of interesting and important developments in the economy and the financial markets. Let me just say we're entering a new short-term environment and a new long-term environment. New short-term environment, likely higher inflation, or certainly fluctuating. Slower growth, economic growth in the developed countries, also developing countries. Headline risk, geopolitics, political, tariffs. That's the short-term outlook. Long-term, you're seeing new alliances being formed around the world. You're seeing new trade restrictions coming in around the world. Deglobalization is certainly a theme that we've been watching. The January month started out this year on the S&P 500, for example, up 2.7%. February was down 1.4%, but then March down 5.8%. For the first quarter, the S&P 500 was minus 4.6%. The NASDAQ was down 10%. So you've had a change in the whole surrounding thought about artificial intelligence. Gold was big for the first quarter, up 7%, up 0.9%, and up 10% for January, February, March. Gold up 18.8%, and it closed the quarter at $31.22 per troy ounce. The two-year Treasury closed at 3.89. That was down 36 basis points. And the 10-year Treasury closed at 4.23. That was down 35 basis points. Growth basically fell severely as the quarter rolled on. We have a mixed economic outlook. The United States is okay, but slowing. China and Europe for the first quarter were showing softness and also slow growth. Inflation, sticky. The tariff talks and the tariff implementation, their effects are coming in. The Fed has been on hold since its December meeting when they cut 25 basis points, as you recall. The Fed policy rate as we end the quarter is 4.25 to 4.50%. Stocks and bonds basically have become somewhat more correlated. You have many days in which they were both moving together, either up or down. Let me just say we are recommending to investors to pay attention, know yourself. Don't make sudden dramatic moves. Have a plan. Talk with your advisor. Try to seek to dampen volatility. Now that leads us to the outlook. Basically, the downside risks are economic growth. Secondly, inflation. Thirdly, I think you could see some legislative or judiciary challenges to some of the trade policies and tariff policies that have come in. They have not yet surfaced in a big way, but as we enter the second quarter, we see some of these challenges out there. Debt and deficit worries are beginning to erode trust and faith in the Treasury market, and so you also see concerns about credit. You're seeing interest rate spreads. That's the difference between high yield or high grade corporate bonds and Treasury bonds. Those interest rate spreads are beginning to widen. There are upside risks as well as these downside risks. The upside risk would be passage of the tax cuts and deregulation initiatives that they've been talking about, the administration. And China and Germany in particular have stepped up their stimulus programs. The earnings growth, we see basically inflation is low and rising, The GDP growth is basically positive but decelerating right now. Earnings growth is also positive and decelerating. Equity, debt, and the dollar have been under some pressure as we ended the quarter. So the spreads, as I mentioned before, are widening. So what does this leave us with? We see in the need for a judicious asset allocation We want to basically direct investors to private equity, private credit, and real estate, private real estate. Private equity, you want to focus on the middle market, the middle market sector right now, and minority and preferreds, okay? Equity preferreds, I think, are very attractive here. You want to have private equity investments where the operator can get growth through operating leverage, not necessarily through financial leverage or through PE expansion. So where they're actually increasing the quality and operations of the business. Private credit, we see private credit is attractive here in terms of income generation. We want you to be in a seniority in the capital structure, and we want to basically see protection, credit protection built in to the private credit investments that you're making. The private in the real estate, you basically office and retail, maybe in our opinion, seems to have bottomed here. We want to basically see your positioning where you have a strong position in the capital structure within real estate. 64% of the real estate part would be to equity real estate, and about 36%, so about 2/3, 1/3 to the credit side of real estate. We overweight preferreds, private equity. We overweight credit, private credit, and CLOs. This is collateralized loan obligations, both for equity and for credit. With that, we wish everyone a great quarter ahead. Thank you for being with us, and we will talk with you soon.